All right, hey guys. We are here for what is this panel called anyway? ETFs to Treasury strategies, what is next for institutional finance and crypto. All right, so let's kick it off with a quick intros for you guys, and then we'll go from there.
Absolutely. Hey guys, my name is Soham. I lead our institutional business at Reserve Protocol. Reserve is basically a protocol in DeFi that you can use to create your own on-chain index. So you can basically launch a token that's backed by a basket of other collateral in crypto. We've worked with a number of the top index providers in the space. We've worked with Bloomberg, Kraken, and CF Benchmarks, CoinMarketCap, as well as Market Vector to launch these index products that they offer to their customers. And we're super excited for the new wave of tokenization that's taking place and being able to use those in our on-chain indexes. In a previous life, I was in sales and trading at Citibank, covering hedge funds and asset managers, and doing some similar stuff in crypto.
My name's Ben Werkman. I'm the Chief Investment Officer of Strive. We are, in this world, we'd be classified as a DAT. We've actually got two sides to our business. One side, we're an asset manager, so we have an ETF business on one side. The other side, I would classify as more of a structured finance company. And we use our Bitcoin balance sheet, and then we securitize around it, and we issue credit products out into the market. Prior to this, I was the Chief Investment Officer of a company called Swan Bitcoin. And earlier before that, I'd started an algorithmic trading firm.
Hi, I'm Rena. I'm the COO of the Stacks Endowment. We are the largest Bitcoin L2. I run the foundation out of Cayman. Essentially, we use our balance sheet for Bitcoin staking and creating structured Bitcoin products using the Stacks blockchain. Prior 4 years at finance and well before energy markets.
Hello, my name is Justin Cohen. I work at JP Morgan. I cover 3 areas at JP Morgan. The first is product and platform for equity derivatives group globally. The second is the same product and platform globally for our strategic index business. And the third is our crypto and digital markets capabilities across our markets division.
All right, so to kick it off, obviously last year, how can we not talk about DATs? So let's start there. Maybe Ben, you can take that and go from there.
Yeah, I would tell you that the last year was really formative in the digital asset treasury space, both in a good way and I would say in a negative way. You saw kind of the mania that happened during the summer last year, where you saw strategy having a lot of success over several years when they built their Bitcoin balance sheet, they got into the convertible bond markets, they started issuing digital credit. And that started to open the eyes of a lot of companies of the power of having a corporation with a really solid balance sheet and finding ways to effectively, actively manage that. How do you utilize that balance sheet? And what you saw last year was there was a lot of capital that became available. These companies found these niches in the market where the volatility of digital assets, or in our case with Bitcoin, that volatility became very attractive to a lot of institutional investors. So you saw an explosion in convertible bond deals that were hitting the market. And a lot of these companies built their balance sheet on top of those convertible bond deals, which seemed like a really great idea at the time. When the markets are really high and everything's going well, it seems good. The problem is when there's easy money entering the ecosystem, it usually has strings. And we're starting to see the cracks of that now, where some of these companies are now running into the collateral requirement, the collateral coverages, they've got occurrences in those bonds. There's a lot of things that can restrict your ability to move. And so you're really seeing a separation within the industry. And I kind of view it in 2 categories now. You've got the treasury companies that are moving off and going the digital credit route, where you keep your balance sheet fully unencumbered, you keep actual leverage off the balance sheet, so you control it, and you focus on issuing credit products into the market. So we were the second issuer of perpetual preferred equities. We issued one called SETA after Strategy had launched several, and we went that path. The other ones now have to find ways to make their balance sheet active through other means. You're seeing M&A transactions out there. You're seeing people try to enter into the derivatives market to generate yields on their balance sheets. But at the moment, because of those convertible bonds and the overhang that puts on you when you see a 50% drawdown in that balance sheet value, a lot of them are stuck at the moment, and people are waiting to see what comes next, or are these companies dead? The short story for me is I think the answer is no, but I do think you see a lot of consolidation start to happen. It's not a secret that scale matters in this space. If you really want to get out into the markets and you want to be able to issue new products, the scale of your balance sheet really does matter. And that's what's going to open the doors. That's what attracts the institutional capital to come invest in your vision for the future. So I think we're in a transition period. And I don't think it's over. I think in Bitcoin terms, this is a very normal correction. People were really hoping that this time was different, that we were out of the 4-year cycle. But what we're seeing now is we still have a lot of those similarities, and we've got to be ready to ride the volatility that brought us here in the first place and made this an attractive place to invest.
Got it. Anyone else have anything to comment on the DAT side of things?
I mean, we're clearly in DAT winter. I think the challenge that I see with a lot of DATs is that you're about to go through your first, second, or third earnings cycle, and you have no revenue to report, and now you have to bow to your public market pressure from your shareholders, and you don't have nothing to answer for them. Very few DATs, yours, actually uses their treasury wisely, whether it's lending against it or looping on DeFi or staking, but not too many DATs have really consolidated and thought about that. One thing I can probably predict is that I do think a lot of the altcoin DATs, I think they're going to consolidate, go unpublic, maybe be a portfolio DAT, and kind of do that take, because you need different income streams.
I could throw one more thing in there. I think when you look at the different assets that are out there, what the market's asking itself is, which ones of these digital assets can you actually capitalize a corporation on? And I don't think that's truly been tested yet. You've seen a couple different assets pop up and a couple different types of DATs. Bitcoin's obviously the primary one that you've seen, and a lot of that is the size of the market, right? It's a trillion-plus asset class. That one fits. It's completely decentralized. I think there's still a lot of questions along with the other ones. They were attractive in the early days because you had those native staking capabilities where people saw the revenue side of that. But I think they're less tested right now than what you've seen with Bitcoin. And I think right now there's less institutional capital, and particularly in the equity markets, where there's a lot of interest. And you see that come to bear when you look at the volumes across these different public equities. If you look at that as the measure of how these companies are really going to put the velocity on the strategy, how they're going to propel this thing forward, trading volumes matter a lot. And the Bitcoin treasury companies, even amongst those, there's a massive separation. You've got about 3 companies that'll trade $80 to $100 million a day, and then it drops off to maybe 5 and below. And so there's a huge separation, and in the altcoin DATs, you're seeing something very similar. Very low trading volumes, very low liquidity, which makes it so that large institutional capital has a difficult time entering into those markets.
Yeah, and actually that's an interesting segue, Justin, into ETFs, right? I mean, obviously we've had Bitcoin ETFs for a couple of years, but last year there was an important development with regards to in-kind creation and redemption. Maybe you can talk a little bit about, well, that specifically, but also what you're seeing on the ETF side. Speaking of trading volumes, I think on the vol side, IBIT options for the first time, bigger volumes than Derivee, even though not quite apples to apples, but still kind of interesting development. So yeah, it'd be interesting to get your perspective.
Absolutely. I think JP Morgan has been involved, and we've taken a strategy that internally we refer to as a securities first strategy that dates back to prior to the creation of BITO, where we were in 2017, where the BTC futures were listed on CME. We sort of foresaw a growth and a future whereby the SEC would come to approve the various ETFs, and JP Morgan was the first and only bank AP for BITO, for IBIT, and has been working along the way there. And I think it speaks to the liquidity aspect that you're speaking to, which is, why is that the case? And I think there is a very substantial 100+ year long history of securities law backing those markets, where people are very comfortable, confident, T+1 liquidity, can build derivatives off of those things, and there's a regulatory environment that permits institutional investors to participate on day 0 without any additional or noteworthy hurdles necessarily. Now, that's not necessarily true if you're a bank, but if you're a non-bank entity, it's broadly true. What that's created is one of the world's most actively traded ETFs, and almost certainly one of the world's most profitable ETFs from an issuer point of view, and also a deeply liquid market that has created an opportunity in both the option space and others to build a broad network of other instruments, whether those are structured products like notes offerings, auto-callables, and the things like that, or converts. One of the reasons people are able to issue the converts in the first place is because they're able to have deep markets that have liquidity far out into the curve, so that they can actually hedge those risks and be sort of delta neutral in a way that is not necessarily possible for first order crypto markets or first order market making participants. Firms like JP Morgan, which banks are not permitted to have proprietary trading arms in the US, are able to be very actively involved in these spaces because they can be market neutral and both facilitate and benefit from that liquidity.
Yeah, and then I guess on the reserve side, it sounds like there's, it's obviously a Delta One product, right? But it's index based. Be interesting to see how that fits in or not to the institutional side, or is it more of a retail product?
Yeah, I think right now what we're seeing is, especially with these new tokenization platforms like Ondo and X stocks, I think what we're seeing is it is mainly retail driven at the moment, and that's what we're seeing on our side as Reserve as well. Is like most of our volume and most of our activity is more retail driven. I think in order for institutions to get involved, the liquidity aspect needs to be addressed heavily. And I think with these tokenization of real world assets and stocks and stuff, the main way that institutions can potentially get involved there is really in like the market making and trading side of things. And so one of the biggest issues in DeFi is the lack of liquidity when you compare it to traditional finance markets. And a potential like prop trading firm or something like that runs institutional capital could step in and kind of bridge that gap between the lack of liquidity in DeFi for tokenized real world assets and the deep liquidity that we see in traditional markets. So that's really where I see, at least in the short term, institutions potentially getting involved, whether it's RFQ-based systems like CowSwap and 1inch Fusion and things like that, or just directly plugging into these tokenized real world asset issuers like Ondo and X stocks to get involved in basically bridging that deeper TradFi liquidity, deeper TradFi liquidity to the DeFi space. And I think that's something from our perspective at Reserve as an index protocol will lead to much higher volumes and much more comfortability with larger players.
Yeah, and I guess that sort of raises the broader question of like tokenization, right? Like, to your point, tokenizing this, that, and the other, TradFi, commodities, or like whatever it is that an institutional play, or is it more of a retail play, or what exactly, who is that serving? That'd be interesting to understand from your perspective. Whoever wants to go first.
Sure. So I'll take a stab at that, because I think there are many opportunities for tokenization of assets, but something that may be uncomfortable for this audience to hear is in some ways regulation makes the market. And so tokenization will work if the regulatory environment supports it and facilitates it in a way that is roughly synonymous with the securities laws and security industry. If that happens, there are all kinds of benefits that we can potentially foresee, not least of which are intraday capabilities, which JP Morgan already has a noteworthy intraday repo product working along these lines, which is effectively a tokenized repo product. We're actively working in the future potential tokenized equity space, which is public equities. I know there's been a lot to happen on the private equity side, but public equities are quite a bit different, especially native on-chain public equity assets as opposed to sort of pointer or reference assets. But once that happens, there are all sorts of potential benefits. So intraday is one. The programmable money aspect of things, smart contracts, things like that. We have a noteworthy derivatives business. We have a large strategic index business where we make bespoke indices for clients. If we're able to do that in a much more straightforward way, leveraging some of the capabilities that are made possible with the tokenization of equities, that is conducive to all market participants, not just some. But to your point, right now it is primarily a retail-driven phenomenon, not an institutional one, in large part because institutions already have access to firms like ours, which help them serve those needs and serve those interests, which aren't necessarily available to the retail space. So they're supplementing that lack with the sort of nascent tokenization aspects that have been brought up. In order to make that market work, both sides will need to play together in a well-regulated space so that we can have, most notably, things like contingency, which is very important. So mistakes happen, and today, by the nature of DLT and things like that, contingency is not really possible by default. It's immutable by default. So we have to go as an industry and go and construct that contingency planning. If an error occurs, how do we collectively undo or overwrite that error and make it right for all the participants involved? Those things are actively in discussion right now from all the various stakeholders that I've engaged with and that JP Morgan's engaged with. And I think it's critical for the development of that market space.
I think from my perspective, I think the lack of a compliance framework, like Justin was pointing to, is really the main hurdle. If assuming in the future, in the medium to long term, that compliance hurdle gets taken away and a lot of the privacy concerns and stuff that institutions have get kind of taken care of, I think then you really start to see, why would an institution transact using digital ledger technology versus in the traditional way? And I think it comes down to the same reasons why institutions are starting to use stable coins versus traditional banking rails, which really comes down to like velocity, cheap fees, and near instant settlement. And those three things, I think, will inevitably over time lead to institutions transacting these tokenized assets on chain. It's to be determined if it's going to be in a public blockchain or a private blockchain or something like that. But I think once the compliance and all of that is taken care of, that's really the thing that would fuel an institution to actually want to transact there, because it's just more economically viable.
Yeah, I think there's a very clear separation between the US and the global markets. And so even for us, we've been seeing our securities getting tokenized, but it's largely used offshore. So for instance, we've seen companies building stable coins. They're building their balance sheet based on our digital credit products, and they're all able to offer yielding tokens, which you can't do in the United States right now. For companies like ours, we do get pitched a lot bringing our common equity on chain. That's becoming a very big push. Part of that struggle is you've got to do it in a compliant framework, and you want to make sure that you can maintain the same QSIP when you're doing that. And that's pretty important to us. But those efforts are progressing. I think it's a when, not an if. But to have that really take off in the US markets, it is going to have to be a highly compliant and regulated framework, which I think went against the original ethos that was going with tokenization. And so I think that's a bit of a shift. But because a lot of this is now being driven by the institutional side, I think that will get facilitated fairly quickly. And you're going to start seeing both a lot of the equities getting tokenized on chain, tradable in real time, 24-hour markets. I think that's going to accelerate very quickly. And we'll see other real-world assets get tokenized here in short order as well.
Yeah. Before moving on, Stacks, what do you think?
I actually had a question for you. So if we're tokenizing everything and we're having the same kind of institutional capital from crypto investing in it, who is on the other side that has not come from crypto investing? Like last week, I think Tether was the largest buyer of their tokenized gold. They're a crypto institution, but I'm actually curious on the non-crypto native who is buying into tokenized.
So right now, I think the answer is no one in particular, because it doesn't exist yet, right? Like when people are talking about tokenized assets, I appreciate that they're talking about things which absolutely do exist because they've created different offerings, but they don't exist through an institutional lens or from an institutional standpoint. So today in public equities, DTCC has a government-sanctioned monopoly on settlement of public equities. They are in the process very publicly of building out their capabilities. That means those capabilities don't exist yet. So for public equities and for other publicly traded securities, the capabilities that do exist are effectively proof of concept or experimental, and they're not for institutional investors at the point. I also don't think that there's a big demand from institutional investors for these services right now. I think because that doesn't mean that there shouldn't be. It means that it's not present. In some of these markets, retail flows make up 30, 40, even 50% of total volumes. And it means that there is a very real opportunity when we talk about tokenization of assets to take that retail reality and say to ourselves collectively as an institutional stakeholder, the broad spectrum financial infrastructure, at least in the US, has not really been updated on the back office side of things in the past 40 to 50 years. It's probably worth imagining that it can be improved. We had one big change in the past few years with T+1 settlement, but T+1 settlement didn't fundamentally change that architecture. It modified the existing architecture to accelerate T+2 settlement to T+1. I think fundamentally reassessing that and creating those new capabilities will naturally bring in institutional investors in a number of different ways. One is the velocity of money, which was brought up earlier, so intraday repo, intraday collateral management, intraday settlement, which is a very real topic for all institutional participants everywhere. The second is on the programmable side of things, especially in the area of derivatives, things like custom and bespoke indices, baskets, and allocations, which play a very big role today in institutional markets, but are operationally clunky. Firms like ours have to employ thousands upon thousands of operational individuals who are experts in their field to make those capabilities possible, which means that they must be limited to institutional clients only. In the future, if we allow and create an environment that technology can begin supplementing some of those roles and supplementing some of those skills, then we'll be able to service more products with greater complexity, with greater velocity of money to an ever broader market, and I think that's really the end goal.
Yeah, and actually, that is an interesting point, which is to say, when things are tokenized at some point, well, everything, let's say, what sort of financial engineering capabilities are unlocked by that are, to your point, cumbersome or very high friction today? And Ben, like like whether it's on the capital structure side or it's in structured products or ETFs or custom baskets, it'd be interesting to see what you guys think about that.
I think the structured products are going to be the big market that unlocks with this. You already see it, right? Structured finance is already huge in the equities markets out there and the credit markets out there. When you're taking an asset, I'll use Bitcoin as the example because obviously that's where we focus. When you take an asset like that, what you quickly realize is while people can understand the value of volatility, not everybody can take the ride of volatility. And so you're able to create baskets of these products and then slice those into different tranches where you can flatten that volatility, you can provide the yields that people want in their portfolios. Right? There's a reality where you have to meet people where they're at with the demands they have in their life. And I think you're starting to see that now. We're in the early days of structured finance around Bitcoin, obviously, with us only being the second issuer of digital credit out there in the market. This is very early. But, there's something to the nature of $6 or $7 billion issued out there in digital credit products today. So I think when tokenization comes online as well, and you can start structuring these products and then issuing them globally, that's going to open a very big market because the one thing I've learned in this space is don't underestimate people's creativity. Right? They will create so many different products, you won't even know where to look for a while, right? It's going to be the Wild West once again. But I think it's really going to push financial innovation forward in a way we've not seen yet.
Big statement. What does everyone else think?
Yeah, I can speak a little bit on at least my experience with the custom basket side of things, because that's basically what we do on chain. The feedback that we've gotten from a lot of our clients, because we do like the monthly or quarterly rebalancing of various indexes, is that the actual process on our platform is much more streamlined. So what we do on chain is we basically rebalance through on-chain auctions where market makers and MEV searchers and market participants can come in and basically fill the orders for whatever rebalance trades that have to occur. And the feedback that we've gotten is that process, it takes about 15 to 30 minutes to do a full rebalance. You have a completely rebalanced index. You have automated trade reports sent out to the client with every single auction that was done, at what price, verifiable on-chain with transaction hashes and everything. And overall, the feedback that we've gotten is that process is much more streamlined to what I guess they're used to in traditional finance, which I'd love to learn about a little bit more about kind of that process and what it entails. But that's the feedback that we've gotten. I think the main hurdle and the thing that we really need to improve upon is the execution side of things. And that comes back to the entire liquidity issue in DeFi that we've been talking about this whole time, and a real area of improvement that we need. Because the reality is the actual execution of the trades is much, much better off-chain than it is on-chain right now. And so if we can improve that liquidity framework, as I mentioned, more market makers, more institutional participants coming in, bridging that liquidity from TradFi to DeFi and making those markets more efficient, I think that's really, will unlock the next kind of phase of, efficiency when it comes to custom baskets and rebalancing and all of that.
Yeah, Justin, you want to comment a little bit on the custom basket side?
Sure. So look, I would say that with or without DLT, or with or without any sort of technological consideration, custom baskets and index rebalancing are sort of an inherently hard problem to solve. If we think about things like MSCI, which is a massive rebalancing exercise, it's touching every time zone in the world. It's touching most actively traded exchanges in the world. Each one of those jurisdictions has their own settlement rules, have their own settlement timing, T+1 in the US, T+2 elsewhere, T+5 in other places. The liquidity for those instruments varies dramatically and sees very substantial dips and spikes in relationship to these rebalancing exercises. And that's a market microstructure phenomenon that's built by heliocentrism, by physics. It's not built by technological sort of capabilities. So any technological capability that can ameliorate some of those very real physical challenges will help bring liquidity to those instruments, because there's genuine demand by global participants, both retail and wholesale, to manage exposure to a global suite of instruments. Even when you take the global suite of instruments out of the equation, you think about something, let's say like S&P 500 or whatever, the liquidity demands and the scale, even at 500 instruments, never mind 2,000 or whatever, because these things are well telegraphed in terms of timing, they happen at quarter end or month end or whatever, there is a very real microstructure shift. So contending with that and building capabilities to contend with that, whether they're execution capabilities in the form of algorithmic development and market connectivity, or back office capabilities in terms of valuation and NAV forecasting and all those and risk forecasting along those lines, building inventories along those lines for people to make sense of the global demand profile, those are all sort of natural challenges of everyday market participants. I am a believer that having things on chain in some format effectively sets the groundwork to reduce some of those risks, because it creates a natural graph of those baskets over time. So whether they're custom baskets or whether they're predefined baskets, having that graph-oriented structure that is sort of abided by multiple market participants simultaneously creates an opportunity to reduce those risks and thereby increase that liquidity and reduce those bid-offer spreads. But it doesn't happen because of any specific technology, or certainly not because of any specific currency or store of value. It happens because of effectively an agreement by market participants to use a common protocol to reference those assets.
Are we up on time? All right, cool. All right, well, thank you very much for the panelists. That was an amazing discussion. Thank you.